Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in company filings, and today we're diving into General Motors Financial Company Incorporated's latest report, which basically tells us how they're handling their money and borrowing it like a pro. Before we get into the nitty-gritty, if you love getting insider knowledge about corporations, make sure you are subscribed and join our Discord community linked in the description below for even more exclusive content and discussions. Now let's talk about what General Motors Financial Company Incorporated is up to. This report details the closing of a massive public offering of new senior notes. Think of it as the company issuing IS to investors, but on a grand scale, to raise a whopping $900 million for their 2031 notes and another $600 million for their 2036 notes. That is a total of $1.5 billion raised. This is all part of their strategy to keep their financial engines running smoothly and to fund their general corporate activities. The company has several types of senior notes already trading, like these 5.250% senior notes due in 2026 and these 6.150% senior notes that mature in 2035. These existing notes are listed on major stock exchanges, showing they are a significant player in the debt market. So General Motors Financial Company Incorporated, or the company as they call it here, recently closed this huge offering. They partnered with several big investment banks, acting as underwriters to make this happen. These underwriters essentially buy the notes from the company and then sell them to investors. The company in turn has promised to protect these underwriters from certain risks, including those related to the Securities Act of 1933, which is all about making sure companies are honest when they sell their securities to the public. This entire deal was made possible through something called a shelf registration statement. Imagine a company getting pre-approval from the Securities and Exchange Commission, or the SEC, to sell a certain amount of securities over time. This shelf registration allows them to quickly offer new notes when market conditions are favorable, like they did here. They filed this statement back in December of 2025, and it became automatically effective, meaning they had the green light to proceed. After paying all the fees and expenses associated with this big deal, the company estimates they walked away with about $1.49 billion. That is a huge chunk of change, and it is going straight into their general funds to be used for whatever they need to keep the business moving. Now, let's talk about what these notes actually represent. They are essentially unsecured senior obligations of the company. This means if the company were ever in a tough spot and couldn't pay its debts, these note holders would rank pretty high in getting their money back. But they are not backed by any specific assets. They are on equal footing with other existing senior notes the company might have. But they are junior to any debt that is secured by specific assets. Also, like most parent companies, their subsidiaries have their own debts, and these notes are considered junior to those liabilities as well. Let's break down the specifics of these new notes. The 2031 notes will pay investors a 4.600% interest rate each year. This interest is paid out twice a year, on the 8th of January and the 8th of July, and the notes are set to mature on the 8th of January, 2031. Similarly, the 2036 notes will offer a higher interest rate of 5.450% per annum. These also pay interest twice a year on the 8th of January and the 8th of July, with a maturity date of the 8th of January. 2036 interest on both of these new note issuances started accruing from the 8th of January, 2026. Here is an interesting detail for investors. The company has the option to call or redeem these notes before their maturity date under certain conditions. For the 2031 notes, this is possible anytime before the 8th of December, 2030, and for the 2036 notes before the 8th of October, 2035. When they do this, they have to pay a redemption price that is either 100% of the principal amount or a calculated value based on future interest payments. This is often done when interest rates drop, allowing the company to refinance at a lower cost. Now, the agreement that governs these notes, called an indenture, also comes with certain restrictions or covenants. These are designed to protect the investors. For example, the company can't just sell off all its assets or merge with another company without certain conditions being met. They also can't easily grant loans or liens to other creditors unless these note holders are treated equally. This is standard practice to ensure the safety of the debt holders. And of course, there are also events of default outlined in the indenture. These are crucial for investors. If the company fails to make payments, breaks its promises in the agreement, or goes bankrupt, these events allow the trustee or a significant portion of the note holders to demand immediate repayment of the entire principal amount. This section lists the actual underwriting agreement. It is the legal document that solidifies the deal between General Motors Financial Company Incorporated and the group of underwriters who are helping them sell these notes. It details all the terms and conditions of this massive fundraising effort. This here is the 61st supplemental indenture. It essentially adds the terms for these newly issued notes to the company's existing master debt agreement or base indenture. It is like adding a new chapter to an existing book, specifically detailing the 4.600% notes due 2031 and the 5.450% notes due 2036. Finally, tucked away here is the legal opinion from a law firm, Latham & Watkins LLP. This is a formal statement from their legal experts confirming that all the legalities surrounding the issuance of these notes have been handled correctly and are in compliance with relevant laws and regulations. So, what does all of this tell us? General Motors Financial Company Incorporated is actively managing its debt to fund its operations. They are successfully tapping into the debt markets to raise significant capital, indicated by the successful closing of this $1.5 billion offering. The terms of the notes show they are offering competitive interest rates to attract investors for both the short to medium term 2031 notes and longer term 2036 notes. While they are unsecured, the covenants and events of default provide a reasonable level of protection for bondholders. At a high level, this filing shows a company that is strategically using debt financing to support its business, and their ability to raise such a large sum suggests a healthy level of investor confidence. There are always risks inherent in debt financing, of course, particularly tied to interest rate fluctuations and the company's overall financial health. However, based on this report, General Motors Financial Company Incorporated appears to be operating with a clear financial strategy, leveraging the debt markets effectively to achieve its corporate goals. Alright, that is our breakdown of General Motors Financial Company Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.